Joining us in Post 9 is Darrell Cronk, Chief Investment Officer of Wealth and Investment Management at Wells Fargo. It's great to have you back.
Thanks, Carl.
What do you make of the last 48 hours?
Well, the last 48 hours, I think, is a little bit of normalness, right? You know, you're finally getting a little bit of selling action. People didn't want to realize the gains in December. I think when you look more broadly at the equity market, though, and what we're looking at on this huge pull forward in the 60 days left in 23, you've got, you go down the list and you start saying, okay, let's look at sentiment. The AAII sentiment poll is a full standard deviation above target. Positioning, to Leslie's point, right? If you look at CFTC data, it's sitting back on its peak of bullishness at this point. You look at valuations, they're at the highest level in the U.S. versus Europe and Asia that they've been through this cycle. And so you start, really the only thing that you've got going for you here in the very near term is the technicals have been really strong. We've pushed above a lot of the technical support levels. The 200-day moving average, interestingly enough, on the S&P is still at 4350, right? Which is way below where we were just trading at 4700 to 4800, which is historically more incumbent on what people think the real value of the market is. Where does the risk reward start to flip, right? So it does look to us like we've kind of overextended a little bit here in the near term.
But it does sound like you think a drawdown theoretically could be maybe more than 10%.
Yeah, I would say anything less than 4,300 becomes really attractive, and you start getting back into that level where the risk reward makes sense, the equity risk premiums start to become attractive again. At 4,800, you've pulled forward a full year's worth of gains. I mean, we had from the October 27th low, we put on 16.2%, right? That's an entire year's worth of gains in 60 trading days, or 60 days, calendar days. So I think you just have to be a little careful here. The market has had, post-pandemic, the market's had this big extreme of, we've been as low as 3,500 in the S&P, as high as 4,800, and everywhere in between. It's interesting, we think 2024, might be the year of equity volatility. We're sitting here at 13, 14 VIX. Remember, 2023 was the year of interest rate volatility. The MOVE index was off the charts, highest level it's been since the 80s. You had multiple days of 2 standard deviation moves in fixed income and rates. Yet equity volatility just sat benign and very low and contained. That may flip, we think, in 2024.
Does that flip relative to the interest rate posture? Because you're right, for the last few years, we've really seen very little in the way of equity volatility, although when equities did move, they tended to move, in concert with what was going on in the treasuries market. So as we look ahead, obviously the 10-year is, teetering that 4% line today. But if there is some sort of a pivot, does that increase the likelihood of volatility for equities?
Well, certainly, you've got the bid ask, right? The bid is the S&P of the Fed at 3 cuts, and the market's saying 6 that Steve just talked about here. Somewhere in between might be the truth. The reality, though, is you need to see that data play out. I think this is going to be a challenging year for the market's job owning versus the real economy performance. We just saw JOLTS, we just saw ISM, right? Neither of those were terribly compelling with what the real economy is doing, both on the manufacturing side. Now let's admit labor has held up much better than we thought it would, right? But still lowest JOLTS reading since early 2021, right? On this morning's print. So you've got to start taking the confluence of that weight. If you do see weakness in the economy, we think it's kind of bound in the first half of the year, right, on the lag effect, and then you start to come out of that in the second year. But if I'm deploying cash today, right, I still think you're going to see better opportunities in the coming 30, 60, 90 days to do so than where we are in current levels today.